Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
All right, good morning, everyone. We are at the McNichol & Associates Asset Management Research Meeting for February 26th. One of our retail plazas in Jacksonville, Florida, reported full year results, so we'll just do a bit of a deeper dive there. Really not a lot has changed. There's a few things I'll point out, and then a fairly narrow charts of the week pack. As usual, we're not providing investment advice or recommendations here. Check us out at mcnicholasset.com. We can help you with all of that. So Crossroads Square is in Jacksonville, Florida, indicated by the red dot, just up on the northern part of the state. And full year results are pretty good. Net cash flow did miss by a little bit. And that was really as a result of timing differences in leasing commissions for a couple of the retailers, but you know what, all in all, pretty good. This is the site plan here. And then in terms of leasing activity, I would say by far the most important one is the 5-year term with Floors and Decor. That's about 85,000 square feet, which is like, probably a third of this entire property. So that's a positive. And then the rest of the leasing activity is indicated there. So good traction on the leasing front. This is just sort of a table that summarizes the previous activity slide. And again, just pointing out the footprint on Floors and Decor at just over 85,000 square feet on a 5-year term. And so that base rent is going to be quite a bit different. I do have a comment on the rent with respect to a few of the upcoming renewals. And here you can see NOI as well as cash flow. So again, net operating income for the year, definitely on track. A slight miss on the cash flow side. Distribution-wise, they did. So just sort of as a reminder, if you're new to these calls or this particular building, coming out of COVID, they did suspend the distribution. They have since resumed the distribution and layered on a true-up provision such that by this time next year, all of the distribution amounts that would have been made coming out of COVID will essentially be returned to the partnerships. And so we'll be made whole there. But all in all, looking pretty good. This is kind of a messy slide. The red boxes or the lined boxes around some of the assets there, just pointing out really below market lease rates on Dollar General and Delicias. So some of these boxes, when they get renewed, are going to get renewed up quite a bit, and then it's just a triple net lease. So if you're new to commercial real estate, just look it up. But when these other retailers renew or get replaced, it should be a pretty decent increase in rent, which is a positive. And now just sort of transitioning into charts of the week. Really, range-bound activity, I think, is what Andrew was talking about last night. The broader measures have continued to reflect resilience, and resilience is good. So not making new highs every single day, but certainly hanging in there. So you can see the S&P 500. I mean, that to me looks like it's transitioning from a phase of being kind of above or slightly overbought to being now more neutral, and that's not bad. That's just sort of the way it is. It could be a lot worse, and Looks like that lower standard deviation line of the 50-day moving average is proving to be a pretty good zone of support. And then this 6,900 range is what Andrew talks about is clear pivot zone for the past 4 months. We'll have to see how that evolves over time. And then the index itself is actually coming into some possible resistance around here, connecting that November to January line. So we'll again see how that goes. I think coming back from our trip, certainly a lot of questions around the concentration of the S&P 500, particularly in some of the large cap tech names, and how that's unfolding here. Its decline, it does look like there is, I wouldn't say a gap, but you kind of get the sense that the upper panel, so the actual advanced decline line itself, is kind of maybe separating from the S&P 500. Granted, these are two different indices, but nonetheless, I think he's pointing out maybe like a little bit of a dislocation occurring. So we'll have to just sort of stay on that. And then with the semiconductor index, it seems to be a little bit more, I would say, correlated in the sense that you've got the index going higher and leading the S&P 500. That's a positive. It usually is. Unfortunately, you don't really see that positivity in software, although the lower panel, the RSI panel, just kind of indicating a potential reversal in the downward momentum. And you can see over here, it looks like it did, it did catch some support here. Briefly, it dipped through it, but then it came back up. And then the last one here is the Sprott Physical Gold and Silver Trust. He still likes this quite a bit, even though it's sort of taken a little bit of a breather there. So that is it for myself. Thank you.
Thanks, Joe. Yeah, that's what I normally look like there. Ken, you ready?
Yeah. I'm a little shorter this week, but I have some interesting stuff that I wanted to share. Okay, cool. Yeah, so just the weekly report. Actually, a lot of the indice-based charts, I just didn't have a great deal of time to throw together, but I threw together a lot of interesting stuff that I found over the week. Just disclaimer at the front end, U.S. disclaimer as well for our U.S. investors. Obviously, a pretty busy week, pretty flat overall. Oil continues to extend its multi-week, multi-month almost rally. Copper is a little off its January peak. Some modest moves within the tech indices, and the Dow looks like it's continuing to remain the strongest on a technical basis and the fundamental basis of the U.S. indices. Obviously, we got some big earnings this week, including NVDA yesterday, which reported Q4 double beat. The stock, I think, right after reporting moved much higher, and then I think it gave up those early gains throughout the night last night. I'm not too sure where it's sitting at right now, but quite the rocky week. Just quickly look at a couple slides here. This is a chart from a Bloomberg article that I reread over the last few days. It just talks about net zero from the UK Energy Institute and the IEA. It just talks about the world's emissions, which have continued to grow despite all of these lofty targets from governments. And you can see the current policies where we're at, sitting in the middle of the 20s, how many emissions we will be emitting, stated policies from current governments, and then the net zero. I don't know how that's going to occur. Obviously, we've been mentioning a lot of these targets are lofty and unlikely, and there's still going to be a demand for fossil fuels, and that's part of our reasoning of expanded demand, especially within the uranium space. Uranium is going to be the, we think, filler within that clean energy space. that's also reliable. So obviously continuing to look at energy. We don't think crude is obviously going to go anywhere anytime in the short term. We've been talking about it for a few months now, but this is just the base crude oil price chart on the technical side, which has created two nice buy signals here. Really the most strength that it's had in a couple of years, other than a short period in the middle of last year after the tariff. But on the technical side, really looking strong, trending positively, overbought. We think oil did bottom, and it will either continue to move in a horizontal manner or move slightly higher. Now, we don't think in the short term there's any catalyst that will raise the price extremely, like i.e. the high 80s, low 90s, but it does seem like in terms of the supply and the demand in the physical market, there is a slight imbalance, and we'll see if that continues. And speaking of the ways we play, obviously oil, gas, the two ETFs here, we do not own either of these, but just proxies for a lot of the firms that we own. The exploration and production ETF on the left, and then the servicing one on the right, which has had much more strength. You can see the real strong breakout. Obviously, on the equipment side and servicing side, you have some refiners, and then you have a number of other firms within the overall energy production space. But both funds scoring really well. Both are heavily overbought, especially in recent weeks. So you might want to wait for a pullback if you don't have any exposure. But we continue to remain bullish, especially with the valuations a lot of these individual energy companies are trading at. Now, this is an interesting chart I read on a newsletter in my email. I think I just got put on a list this week, to be frank, but the chart really interested me. Just talks about the Mag 7 X Tesla. It's a pure average PE ratio versus the consumer staples forward PE ratio. Now, when you take out Tesla, these two groups are trading at the exact same forward multiple. Obviously, for the Mag 7, an average is not obviously a weighted, but you can see how expensive that these staples have become because of this rotation into defensive names. We've been mentioning it for a few months now. We do hold some quality defensive names, we think, but the overall sector, especially in the United States, very expensive, especially compared to historical averages. You can see how elevated the valuation is over the last 10 to 11 years for the staples index. And then when you compare that to the Mag 7X Tesla, we've seen a bit of a pullback, obviously, with the returns slowing down for a lot of those Mag 7 names over the last 6 to 8 months, other than Alphabet. Now, just talking about the oil industry, this is a chart from Clarkson Research. It just tracks the super tankers and the cost of hiring a ship. And these are obviously pure tankers approaching 100K at the highest point we've seen in over 15 years. So something really to look at when you're looking for some industrial exposure within the shipping space. Perhaps add some exposure in the tanking area. And then I think this might be my last slide. This is just an emerging markets slide that is a relative strength chart. So it tracks two separate indices, and the direction it's moving in shows the strength for which one on a relative basis. So for this chart, it's the S&P 500 versus the EEM ETF. We just reversed for the first time in 16 years on this relative strength chart. Perhaps a real rotation to the emerging markets or even global equities. We're seeing it unfold under our eyes. Obviously, last year we saw some really strong performers in the emerging markets. We've seen some really strong performers to start the year. And the technicals are really painting a strong picture for non-US equities, we'll say. We'll continue to show slides like that and continue to rotate our clients' capital as we see fit. And I think that's it for me, Dave. So just a quick one this week.
Yeah, that's great, Ken. And I'll get the weekly beacon to you this morning so we can get that out tomorrow morning. All good.
Awesome.
Okay. Charts of the day, defensive rotations. Okay, thanks. So this is Michael Coolbaugh's contribution. Only two times energy and staples plus 10%, while financials and tech negative. Not great historically. So that's just telling us that the market might be in for some challenges. Hedge fund degrossing. February hasn't been kind to long-short equity funds who've been forced to degross. Have we hit a short-term capitulation point? Long-short leverage. This stark difference between gross and net leverage is one reason why we've seen violent rotations and not broad risk off. Net exposures are muted. Elevated gross relative to muted net means as long as were added. So we're shorts. Hence this simultaneous unwinds. Okay, sector. S&P 500 sector year-to-date performance. So there's energy is the big winner. Financials the big loser. And whether you're looking to play the rotation or simply want to be aware of the vulnerabilities, this year-to-date graphic does a pretty good job. Guess what are the weakest performers today? I think he means as of the day he wrote it. Energy, materials, staples, and industrials. iShares tech fund sector. This 76 to 77 area in IGV has been really popular for dip buying over the past few years. What if Citrini was a short-term capitulation event? Bullish momentum divergence at multi-year support. Yeah, so we saw that with the NASDAQ starting to show some strength there on some previous charts. And then here's some companies, insider buying here for ServiceNow. CRM, just what the other analyst there was about to start talking about. Despite the SaaS collapse, apocalypse, I'm trying to read here. Fears from Monday, software is now trading above Friday's close. Can the EPS report after day's bell relief some fears? So we'll have to take a look at software. Maybe it's doing a bottoming here. A rubric. Buyers last stepped in here back in April of 25. Another name with a potential false breakout and positive momentum divergence. Okay, so that's it for that one. The new grants is out, and yeah, I've only scanned through part of it last night, talking about some Spanish banks and in the dog business. Supposedly, people are going to the vets less than in the past, 3% down, and so this is one of his ideas, coitus, based on how inexpensive it is. Pick of the litter. And what else? I've only got through half of it. And more emerging markets commentary. Thanks to the president, they're blaming it on. It's probably true. And yeah, so we'll get through the rest of that and report on it back to everybody. The morning coffee hasn't come in yet. Actually, let me just take a quick look. If it has, I'll take a pause here. I'll pull up today's, but I'm guessing it hasn't come in yet. Nope. We're on the B list. So this is just from yesterday, so it's not too far out. And yeah, so Canada continues to get stronger, led by the venture exchange. The NASDAQ is just starting to show some recovery that we saw in the charts there. And green across the way except for India. Yeah, India's just can't start to find a leg there, and Japan being the strongest in the world. Look at that, up almost 14% after almost 2 months. Crude's holding in there, nat gas under pressure, and gold and silver still tracking very well. Almost 5,200 for gold and almost 90 for silver. So I'll comment on Canada US dollar on the point and figures, and same thing on interest rates. And there's yours, Sean. I'll have it as a backup if yours isn't working, but looking forward to hearing your words. And finally, I'll finish up on the playbook here. So no change in the Canada US dollar. Same thing for the targets. Short-term indicator of 78 cents, and the long-term still down to 62. So nothing's changed there. The US dollar spot index, nothing's changed there as well. Jump too much here. Okay, here we go.
Where's it got Bitcoin headed?
I'll come to that in a second here. Okay, copper $6 up to 670. Uranium up. So those two have changed courses. So that's positive for those two areas. Same thing as gold. The gold futures measures over 6,000 now, and the spot price over 5,500 from where it is now around 5,200. Gold bugs, gold miners, junior miners, the whole precious metal complex now is back to the way it was again. So this is why we don't trade it. It's just too challenging to do it unless you're just doing your own single account. But with many families, we have to stay the course. And then platinum actually looks like it's got to its peak there. And same thing, sorry, for junior silvers. They measure quite a bit stronger. Okay, here's Bitcoin. Yeah, it measures down to 22,000. So it looks dead there. But Ethereum measures up. That's odd. They should be working in tandem, I would think, but up to 2,400 for Ethereum, and Solana up to 104. But the whole crypto index, it looks like it's going to be cut down by another 2/3, according to this. So once again, these are just sort of momentum indicators based on the mathematics of point and figure. So it is not 100% foolproof, but I find it gives a good idea of trends. Okay, now the big banks in the US measure down, regionals measure up. So we're well prepared for that with our regional bank partners. And Canada still looks strong. Crazy Canadian market when, you can't give away a condominium in Toronto. US brokers measure down, and then finish up here on interest rates. I'll pass it over to Sean. Okay, so 2 years still looks the same at 3.5 down to 2 3/4. 5-year down to 3.3. 10-year up. That's a bit of a change from 4% up to almost 5%. And but then the long from 44.7 down to 4.1. So yeah, that's, I think I said to you, the term, it's like a sine wave. It's looking like right now. So not your normalized yield curve. And the VIX looks like at 18 down to 13.5. Volatility looks to be exiting the market. And that's it for me. So Sean, you want to take it away?
Okay, this is my macro overview, not financial advice. Do your own research, best efforts, including the cartoon. Good week over the past week, up almost 6%. Reduced the cash position, exited the 2-year futures trade with a small gain. The crypto market is still broken despite yesterday's move. We can get into that in a minute. Big picture, capital spending in AI is now a little bit of a question mark. OpenAI, which I think is keystone to watch here, is showing a couple of cracks. They're having to fund. They're pulling back their AI spend from 1.4 trillion to 600 billion, which is still an astounding number. They just did a deal with AMD. In the headwinds, I'm still watching Japan. It's, kind of behind the scenes and quiet, but it affects a lot of the carry trade. Political uncertainty, I think, has ramped up a little bit with the recent tariff reversal by the Supreme Court. how that's going to play out. Bitcoin remains in a bull market or bear market. Oil is in a bull market, but we'll get into that. I think the US is going to take action. Investment themes. The thing added here is the war with Iran. Like, this buildup is not going to go unused. Trump is known for chickening out. He wants a diplomatic solution, but Hegseth is a very ambitious guy. I'm watching for the spin, kind of like the Iraq weapons of mass destruction, that they have to go in. On the surface, it does not seem like it's a good idea. This could result in massive fiasco. This is not like going into Venezuela. Asset classes, here we switch to look at the last 200 days. I mean, they outperform at gold, but the S&P, like 22% over the past 200 days. It's just a phenomenal market for everyone's 401ks, frankly, RRSPs. Economics, little has changed in the last week. Growth has continued down. Remember, we were up at 5.4% by the Atlanta Fed projection. We're now at 3.1. It was 3.6 last week. Commodities, you see turbulence everywhere. Iran is causing a spike in oil. That's a tax on every consumer in the world. Silver is up largely on Chinese solar demand and potential squeeze for the physical. We'll get into that. The US dollar, not much has changed in the past 6 months. We're kind of range bound. It's a big range, but it looks like everything is pointing to the US needing a weaker dollar. They need a weaker dollar to generate exports. It's going to pinch on the imports a little bit. They're trying to reshore. They need to export. Most advanced countries now have the ability to more than address their domestic populations. And that's certainly going on in China. They are going to export deflation to the world. Gold remains in a bull market by all the moving averages, by all of my technical indicators. We had that parabolic move that got addressed when the CME changed the margin requirements. It's not a lack of demand. It's just that people were speculating on that parabolic move. When margin changes, people have to sell in to meet their margin, and that's what happened in spade. That's the big negative red candle. Massive move, but it was also a massive opportunity, especially in silver. Now, silver is consumed. It is used up, and the demand for solar, for data center use, for electric vehicles is high. Doesn't seem to have an end in sight. If I target, where should this be based on what gold did, what copper did, the relative industrial use, it looks like the target price should have been in the 50s and 60s, which still from a year ago is a doubling. But we're nearly triple. Now think about if you use silver as an input and the price tripled, boy, like that is a massive shock. And there's still a premium going on in China for physical of up to $14 an ounce over where it is spot in the price discovery market in the US-based futures. So even though my target fundamentally is 50, 60, what's going on behind the scenes, we could see silver push up through $100. And Dave can tell you, when the silver market fell, I was buying at 70, 77, 78, both in the futures market, spot physical silver. I've held options. Currently, I have a put option on silver because I'm expecting another margin change. However, fundamentally, I'm quite long silver. March is typically one of the biggest months for silver delivery. And let me tell you, it is going to be an absolute entertaining show over the next 31 days. Bubble versus not a bubble. I'm saying that there's speculative excess going on in the market right now, but at the end of the day, we have to respect price. Price is what we do on a daily basis. It's what generates returns, and we can have all the opinions in the world, but we got to respect price. Oil's currently looking like it's in a bull market, but this is all, in my opinion, based on Iranian regime change. Now, If we look back, we've had pops of 16% and 20% last June, for example, when the Israeli-Iran conflict lasted 12 days. We went from 60 to 78, type 80 levels. So from here, we could pop, I would say, in the 75 to 85 level. And then I think it will come down quite quickly. I think that when push comes to shove, I think even though Iran has some pretty good capabilities of striking U.S. vessels, I think that they will very quickly find out that a couple EMP pulses and some of the advanced weapons the U.S. have, their defenses are going to be knocked out pretty quickly. And I would expect that we return to this long-term downtrend that'll see us into the 50s. The Saudis are currently operating at a deficit. If they can't pump up the price, they are going to have to output more. And I think that's true of Russia as well. Like, I just see output exceeding demand over the next year. And I think that $50, $45 oil will see it in the next 12 months. Rates and credit, pretty boring, except for credit. I said last week, high yield is becoming higher yield. Private credit company Blue Owl is the first and biggest cockroach, and it's getting squashed. Here we can see it had a nice round trip over 2.5 years, up from $11 to $27, $26, and now back down to where it was 2.5 years ago. They've gated retail. This is the fear of the SEC. Expect the SEC to start probing this stuff. All these promises of like, oh, we'll provide liquidity, we won't gate, blah, 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 all turned out to be bullshit. When people can't get their money back, people panic. U.S. equity, while resistance at 7,000 on the S&P 500 continues, the breadth is okay. The VIX term structure is great. We'll take a look at that in a second. We haven't seen that for a while. The earnings trend is positive. NVDA did okay. If NVIDIA had really disappointed, I think it would have been a notable turn in sentiment. And we've gone from fear in the fear and greed index up to neutral. I love this. I mean, I think it's got room to actually break higher. Here we see the VIX curve. We have spot at 17.77 this morning, well below the front month contracts and an upwardly sloping curve. Typical, normal, bullish setup, frankly. But the S&P is flat. And while it's flat, the technical indicators, where you can see on the far right, you can see how clear they were since the tariff tantrum. We went through a little spat of like red. We had a couple of VIX inversions, which you can see in the second to bottom chart. But breadth in the lower heat map is returning to being good again. So like we've pointed out, we're getting a stronger rotation into a lot of other names. The PE on the MAG 7 have come down. And I'm actually starting to think that the MAG 7 might get new life. And that was in my comment this morning. If Apple does a good job integrating AI into Siri, and all of these devices that Apple runs, like Apple can do consumer well when it really puts its mind to it. If every Apple device has a good version of AI via Siri, I think it will re-excite the market as to the potential. And the other thing is, I don't think we're going to see like massive job losses. Jobs are made up of tasks. I think AI will help with tasks, but I don't think this fear-mongering of mass job losses is going to come to pass. I've started using volume profile more and more, and it sure looks like the S&P is just stuck in the box. It can break to the upside or it can break down. Right now, based on this volume profile, like we're in this box, and I'm hoping we have a good break to the upside on getting past the war with Iran and getting back to a good trend in oil and some positive news out of the tech space. Crypto's just a broken asset. Yesterday was like fantastic for the stuff that I hold still, which is way down from where I was at the beginning of or all through last year. But I still consider it a broken asset. The technicals point to continued weak price action in the short term. And at the end of the day, who needs Bitcoin? Like right now, it's just not performing. It's not serving as a debasement trade. It's not kept up with gold. Gold now, the market cap of gold now exceeds that of the S&P 500. Stable coins are getting all of the love right now, and Meta is reviving its stable coin idea, it seems. Again, we're in the fourth year of the 4-year cycle. Typically not a good time to be in crypto and Bitcoin. Post-trade analysis, the 2-year exited with a tiny gain. Growth is coming down, but not fast enough. And I think there's much better places for me to put my capital. And then the joke of the day. The Wall Street Journal yesterday reported DOJ to review whether Epstein files about Trump were improperly withheld. Guess who's doing the review? The DOJ. So there's Pam Bondi, doing the review. That's it from me.
Okay. We try not to get political here because there's always two sides to every story. Okay. Chris Curry. Yeah, there you are. You ready to go?
Yep, I'm here, Dave. Liking this little voice modulator on the right side of the screen. Very effective. I hope you can hear me.
Just fine, thanks.
Oh, good. Excellent. So I just wanted to follow on what John was saying about the blue owl. We certainly have our blue owls in Canada as well with, we point to the big ones, Brookfield, Onyx, and Power Corp spent a lot of money buying a private credit company called Sagard. So that might be what's hurting Power Corporation stock, this private credit fallout. And I'm sure there's some small cap names that are going to be heavily exposed in this private credit sector, fallout. I mean, we've been following this story on this call for quite a while, ever since that the big private credit blow up a couple of years ago. And, I think there's more to come in that area. And that actually is positive for the public high yield market, I think, because a lot of the, I don't know what you're trying to be polite, but a lot of the refuse or whatever, I think has been picked up by the private credit, which I think, not coming into the public markets means clearly less pressure on ratings downgrades and bankruptcy rates. So, but I do think that's going to be really the space to watch. But in terms of how that flows into the overall economy, it's pretty hard to call a recession when there's so much downward pressure on rates. And want to just see if my share screen works here. No, I guess I'll have to get some tutorial on that one. Anyways, what I wanted to show was interest rate expectations as of, this morning in both Canada and the US. Canada, nothing. We're done for the year. No, the highest probability occurs in July with sort of an 8 basis point move. You obviously need 25 basis points to get a rate cut or a rate hike, and that's just not in the cards. Rates are super low in Canada, and are going to stay there for quite a while. In the U.S., a little different story. That's been bouncing around all over the map, and we're actually right back to the Fed forecast of 2 cuts. And they are forecast to occur now in either July, September, and later in the year, December. So 2 cuts. But the interesting thing is that the market's now expecting these cuts to roll into 2027 and, a further cut in April of 2027, whereas the market actually had, as of a couple of weeks ago, market had rate hikes at the end in Q4 2026. Now expecting cuts. So to me, that is, very positive for stocks. The only thing probably that can hold it back is this credit story, and there's probably more to come on that. Onyx, interesting. Onyx had bought that Howard Marks company. What's Oak Tree or whatever? So it would be interesting to follow what sort of comes out of that. So. Yeah, on that note.
Was it Onyx or Brookfield? I think Brookfield did.
Was it Brookfield? My apologies. Okay, yeah. My apologies. Yeah. Brookfield's loaded up on this stuff, and but they're masters of shuffling it around. And
that's true. Is there a way to navigate this private credit space. As you know, we've been planning on launching our debt fund for 100 years now, and we actually are. It's imminent now. And so naturally, we don't want to make any mistakes out of the gate. And love to find a manager that's actually done well through this space and kept liquidity. Okay, that's great. Chris, thanks. Gilbert, do you want to wrap things up?
Yeah, absolutely. Let me just share my screen here. It's going to be a quick one today here with the short report. Hope you guys can see this. The disclaimer here.
Yeah.
Once again, S&P 500. Look, we've had a couple of strong days here with the S&P 500 coming up off of this bottom low range. However, again, what I want to point out here is that we're still in this range, right? And we've been in this range for a while, and it makes sense that we would see the market maybe try to make another attempt at it. But just like in the start of 2025, that really preceded a move lower. And that's not just the case then. It's also the case at the start of 2022 before that protracted bear market where markets were going sideways for some time. We got a new all-time high. Everybody's happy. And then what happens is we start to see the market sort of turn around. Again, we're not making any predictions here. I'm not making a prediction here, but we have to be cautious, especially given the fact that we're still seeing this rotation out of growth here, despite the fact that we've seen a little bit of a sort of a pause in terms of the software decline. NASDAQ 100, again, same sort of thing. It wouldn't be a surprise to see this come all the way back up to that previous range, which was at the top there. But when we look historically, that doesn't necessarily mean that we're going to be breaking out and pushing higher. And one of the reasons why is what we've talked about before is valuations here. The CAPE ratio is now trading at 40 times, which has, again, only been rivaled by the height of the dot-com bubble. So again, things are expensive. And as I pointed out before, longer term, we look at credit spreads, very, very narrow, very, very tight. The last time we've seen this was before the decline, the tariff tantrum at the start of 2025. And again, previous to that, it was at other times where we saw markets start to roll over. And so a short-term increase in markets or a short-term gain in markets is obviously something that everybody would be cheering for. However, when we take a step back, all of these factors are suggesting that there might be a reason to have pause. Now, we've talked about the rotation into defense from growth here. We see that over the last week, it's sort of paused a little bit here. And that's not out of the ordinary, because even when we look at 2022, during that big rotation out of growth and into defense, there were periods where there was a rotation back into growth, even in the short term. And so if we're talking about a sort of a larger term move, it's not a surprise to see a bit of a pause here. And if there's a rotation into growth, especially given the fact that NVIDIA did okay yesterday, then that's something that wouldn't be a surprise. Again, market breadth, not at extreme levels. And so it wouldn't be a surprise to see market participation increase a little bit here rather than roll over. That being said, there still are a lot of risks here with our partner at Universa. We have a solution to that. It's low cost tail risk hedging. So if you're watching this on YouTube or anywhere else, please reach out to us if this does fit your profile. So that's it for me.
Okay, well, I think that's it.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.